Hi everybody, welcome back to another video. In this video, we will go through the earnings of Capitaland Integrated Commercial Trust and Capitaland Ascendas Reit. We will see what are the green and the red flags of their businesses and why there is a difference in the performance in both the share price and the dividends. Let's go on to the first REIT, and that will be Capitaland Integrated Commercial Trust. For those who are new to CICT, they are a REIT that focuses on retail, offices, and integrated development, which are mixed-purpose buildings. Most of their properties are in Singapore with revenue contribution of 95.1%, while overseas plays a very small part. From their individual performances, we can see that it's good with retail and integrated development portfolio increasing. Even though office portfolio decreased, it was due to the absence from one of their assets, which was the 21 Coiler Quay. If the comparison was done like for like, revenue and NPI would have been up slightly. With this led to amazing results because the more important factor, which is the distributable income, came in much higher at 12%. This led to higher dividends of 3.5%. Reason is because of more contribution from Ion Orchard, better performances from existing assets, and the most important one is the lowering of interest expenses. We can see that the interest rate has peaked for CICT, with the average cost of debt dropping by 0.2% year over year. Results were very good in this slide as well. Rental reversions came in strong for both retail and office, which shows the attractiveness in their properties. This is especially the case where MPAC office building was encountering negative rental reversions. Tenant sales and shopper traffics were up significantly thanks to Ion Orchard's contribution. Moreover, they have made the correct move with divestment of Capital Spring at the exit yield of 3.6%. This meant that it was sold at a very good valuation because the yield was very low. I favor the management decision of paring down debts using the funds and to use the remaining funds for asset enhancement, which is good rather than giving out as dividends. With the funds, it will definitely be beneficial for shareholders in the long run as they are currently making a few asset enhancements which will boost the income for shareholders. We can see that it's very good as they are actively improving their assets in Germany, Singapore buildings such as IMM, Lot 1 and Tampines Mall. These asset enhancements will definitely or should expect them to bring in more income for CICT. With the funds being used to pay down debts, their leverage ratio might continue to drop, and this will definitely help in lowering their interest expenses. Moreover, interest coverage ratio is increasing well with cost of debt peaking at 3.4%. With the Singapore SORA rate dropping quickly, as we can see from our Singapore bank's results, it will definitely benefit CICT, and we should continue to expect their interest costs to drop due to the refinancing. With this, CICT might be in for good performance down the road as their debts in 2027 and 2028 might be able to refinance at lower rates when they expire. Lower rates will equate to lower interest expense, therefore providing REITs with more income to give to shareholders. However, one risk still exists for CICT is the finishing construction of the JB Singapore RTS. We have to look closely on the impact that it will have on the REIT, as this would mean that locals will be able to travel to JB more easily for cheaper alternatives. Overall, they have performed fantastic with higher dividend of 3.4% year over year thanks to higher income and lowering of interest expenses. We should expect their interest expense to continue decreasing and dividends to increase further because of this. Moreover, with the asset enhancement undergoing, this will help to pave way for more higher income in the near future. At the current share price, with semi-annual dividends given, its dividend yield is in the range of 5%. Although the results is good, I will consider this REIT to be one of the more expensive one because the dividend yield is quite low. Now let's go on to the next REIT, and that will be Ascendas Reit. Ascendas Reit is one of the largest REIT in Singapore that has a very diversified portfolio. They have properties mostly in Singapore at 65%, while other countries are in US, Australia and Europe. With so many different properties, What gives Ascendas REITs advantage is that when they make improvements to certain properties, the temporary downtime due to the improvement will not greatly affect their overall income. However, for this quarter, Ascendas REITs may not be showing the best results. Both revenue and NPI is down due to the divestment of their assets, offset by lower operating expenses. However, although distributable income is the same, distribution per unit, which is DPU, dropped due to larger unit base of shares. Honestly, last quarter with their positive rental reversions and contribution from new property, I would expect their income to grow. However, it came in lower as the divestment has a larger swing in their income. On the bright side, they have been quite active in the market with new acquisitions announced, which are decent assets as they are in Singapore. Data centers are always attractive assets to have, and they bought one in Tai Seng with net property yield of 7.1%. In Singapore, data centers is in high demand, and having these assets will definitely benefit Ascendas REIT in the long run. It also has 100% occupancy with new lease agreements already made to commence in 20th June 2025 for 10.2% of the space. Another acquisition is the Science Park, which is at 100% occupancy. However, the lease is shorter at 1.5 years with lower net property yield of 5.7%. This will definitely be a more risky asset and hopefully will continue to perform well for Ascendas REIT. Looking at their debt-wise, it's good with leverage ratio dropping while cost of debts maintains at 3.7%. With Ascendas REIT having such a good credit score, I feel that their cost of debts will be expected to drop as they refinance their remaining debts that are going to expire. So it's to be seen for 781 million of their debts that needs to be refinanced this financial year, whether it will increase or decrease their cost of debt. Occupancy-wise, there's not much change. The only highlight will be the Australia occupancy, which has increased significantly from 89% to 93%. Like I mentioned in the previous quarter, it was predictable that they would do well because occupancy in this country was logistic with strong rental reversions. We can see that from their breakdown of the rental reversions, all of them are performing well, particularly Australia logistics with a high of 18.6%. I will expect the occupancy to continue going up with such good demands. Overall, what can we conclude from Ascendas REIT's results? Surprisingly, income came in lower, which is disappointing. Larger unit base led to a lower DPU of negative 0.6%. So we have to focus on the finance expenses when they refinance the loans they are expiring this financial year. And I'm still optimistic that they will continue to do well this financial year, similar to CICT. At the current share price, its dividend yield is around 5.4%. Overall, CICT continues to perform well as expected, resulting in higher dividend, while Ascendas REITs will have to see more improvement in their results. Thank you so much for watching. Please support the channel by hitting the like, subscribe, and comment on your thoughts on Capitaland REITs results. We will greatly appreciate if you can support by using the links below that will help the channel. Mapletree REITs also will announce their results, but there are various reasons why it's not performing as well as Capitaland REITs. And if you are interested in banks' recent earnings, you can also see the video here. Thank you, and I'll see you in the next video.